on this computer. All right, recording started. Welcome everybody. This will be recorded so you can go back and watch, but you know, pay attention. I guess you guys are here for an hour and a half, so might as well make the best of it. All right, does everybody see the screen right here with accounting prep Excel? Give a thumbs up, good. Okay, let's dive right in. So the first three tabs are cash flow statements. So we'll go, and I have a few problems that I created myself over here that we can go over as well. I hesitate, so I'll try to leave some room at the end for questions, but I hesitate to go over the Canvas questions because the final samples from a bunch of question banks, and I, don't want to help you cheat or anything like that. So if you do have specific questions at the end for it, I will try my best to walk you through it, but I won't give you the answers. If you like come up with the answers, I might nod or something. Okay, this is the cash flow statement for a company called Fastenal. They make fasteners and tools, manufacturing company. I just want to go through first base level identification of items on the cash flow statement. So anybody can jump in. Cash flow from operations, what is it?
It's the top. Nope, I don't know.
Oh, first of all, let me ask you this. Is this direct or indirect? Good point, Jackie.
This is indirect.
Indirect, yes, why? What indicates that?
You're adding back in depreciation.
Yep, what else?
You're starting with net earnings.
Yes, very good. That's usually the biggest sign that it is indirect. You start with net income. Very good. Cool. All right, let's go back to the first question. What is net cash provided by operating activities?
Is it the 842.70?
Yeah, very good. This one down here, 842.7. Nice. All right. Does anybody have questions on that? Does that make sense? So far, we're just identifying cash flow from investing. Let me scroll down.
It's a negative 239.7.
Very good. And since it's negative, what does that mean?
It means that they bought long-term assets and
Very good.
spent more cash on that than they got in.
Yeah, exactly. Yep. 239.7. Okay. Very good. And cash flow from financing.
Negative 595.1.
Very good. Yep. And similarly, 5.1. Since it's a net negative, they on a net basis they spent more cash in financing than they did. Jumped in a little bit. I did not share this file. This is recorded. I can share the file afterwards, and I'll delete the answers. Is that okay? Cool.
Thanks.
Yep. All right. Great. Okay, so on to the next one. So these two sections are pretty straightforward, cash flow from investing and cash flow from financing, because they're typically like one-off items. If you sell equipment or if you buy equipment, it's a pretty big purchase. You're not going to do it every day, or it's not a normal business activity. Similar to financing, if you take on debt, it's pretty big decision and usually pretty big numbers. Paying dividends usually once a year. So when you do this stuff, you'll know. Pretty straightforward. The more complex one is the cash flow from operations, especially since we're doing indirect. So with indirect method, you start with net earnings and you add back all these non-cash expenses and non-operating expenses. Can anybody tell me why? I guess I kind of gave you the answer.
Because it would go down on the balance sheet, but you're not expending any cash.
That's the next section. Jumping ahead a little bit. This is kind of you're adding back depreciation, bad debt expense. Why do we do that?
Because they're non-cash expenses that have impacted your income statement.
Exactly. Yeah. The depreciation is not a cash expense. So you add it back. The net earnings number, this number, incorporates all these non-cash expenses like depreciation. You don't spend any money for depreciation. So you add it back to reflect what really happened with cash in operating. Very good. And Carol was jumping ahead, but on this account here, she said some of these are non-cash items. You have to kind of incorporate the adjustment. So I kind of want to ask a different question here is, did these accounts go up or down on the balance sheet? So trade accounts receivable, this negative 30.4, did it, another thing I want to say is that this is the change, right? So this is beginning or ending balance minus beginning balance. So when you see this negative 30.4 on the cash flow statement, did the trade accounts receivable go up or down?
They went up.
Yes, why? Tell me how you got your logic.
Because if it's on the statement of cash flows, if it's written as an outflow, that means you're kind of losing out on that receivable, and therefore your receivables are actually going up.
Yeah, very good. Did
Like
I
you're
lose
losing
share?
out on
Sorry, I lost my sharing. Sorry about that. Yeah, very good. Ashana, is that how you say it?
Ashna, yeah.
Ashna, sorry. Okay, cool. Yeah, so this went up. Essentially, you know, accounts receivable is related to which income statement amount or account?
Liabilities.
No, income statement account. Think about it.
Accounts payable.
That's a liability account. On the income statement, when you, so when would you increase your accounts receivables?
When you sell something on credit.
Yeah, exactly, right? So what account is it related to on the income statement?
Your revenue.
Revenue, yes. And revenue is incorporated into this net earnings number, right? But all of revenue is incorporating, whether it's cash, paid for in cash or paid for on credit. What this is doing, the accounts receivable, when you reflect the change, is that you're saying, okay, accounts receivable went up by 30.4. That means we didn't get paid for some of that revenue. We didn't get paid for 30.4 of that revenue. And that's why we reflect it into this indirect method of cash flow from operations. All right. Inventories. There's a negative 84.4. What does that mean for inventories? Did it go up or down on the balance sheet?
I'm thinking it went up on the balance sheet.
Yes, very good. Inventories is less logical, or it's less intuitive, but the general rule is current assets, if they go up, it's a cash outflow. If they go down, it's a cash inflow. Okay, that's the general rule for current assets when you're talking about or you're making the cash flow from operations. Okay, everybody good with that?
Could
Questions on
you
that?
like explain, so like just walk through like what happened with the inventory? I guess I'm just not registering it.
Yeah, so it's easier to explain with accounts receivable, right? You didn't get paid for a certain amount. With inventories, like inventories gets reflected in the cost of goods sold, right? Does that make sense? Like you build your inventory and then when you sell it, you take it from inventory to cost of goods sold, right? It's expense, it's reflecting what you spent to make that inventory, to make that sale. However, if inventories increased, presumably you paid for it in cash. That's kind of what it's reflecting here. Inventories also play with accounts receivable. Those two, when you make adjustments for both of those accounts, it reflects what happened in cash. It's
So for this instance, we paid 84.4 for inventory.
yes. So inventories increased by 84.4, right?
Okay.
And you might say like, okay, well, maybe you didn't pay all of it in cash, right? Like, and that might be true, but that gets kind of trued up with the accounts payable section. That's where you see, that's where that adjustment makes it what happened in cash, makes the cash transaction true. Does that make sense? What I'm
Yes,
saying?
thank
I know it's a little difficult to intuitively understand the inventory, but the general rule applies to inventory as well. Okay, so if it's a net cash outflow, then it means it went up. Okay, accounts payable. Any volunteers?
Would accounts payable go down?
Yes, it went down. Tell me why.
Because since it's an outflow of cash, that means you were paying off some of those accounts.
Yeah, very good. Yeah, so accounts payable, you know, it went down by 0.8, means you paid 0.8 of whatever you owe to your suppliers. Okay. And accrued expenses. A cash inflow of 10.7. What does that mean happened to the accrued expenses account on the balance sheet?
It also went up.
Yeah, it went up, right? Okay, so if you think about the accrued expenses or just liabilities in general, if liabilities go up, it means you didn't pay for something, right? Like you got the benefit, but you didn't pay for it in cash. But remember this net earnings number, it incorporates all the revenues and all the expenses, no matter if you paid for it on credit or if you paid for it with cash. So you have to reflect what the true cash activity was. Does that make sense? Yes? No? Questions on that?
So
Yes.
since the accrued expenses is positive, would that mean we paid for something on credit and just haven't paid that back in cash yet?
Yes. Yeah. So presumably somebody like maybe a marketing firm came in and performed some services and they haven't invoiced you for the services yet. You haven't paid in cash. And so that expense, whatever the marketing firm, the services they perform, say it was, say it was $10.7 million, right? That expense gets reflected in the net earnings number because it's in the income statement as some kind of marketing expense, but you didn't pay for it in cash. So you add it back to reflect what happened in cash. Cool. Very good. All right. On to, does that make sense? Yeah, go ahead.
If it's an accrued expense, isn't it a liability? So it's not really in your income statement?
It's a liability, but you remember when you make a journal entry, there's two journal entries, right? Or at least two. So you have to make it balanced. The opposite side of an accrued expense is the actual expense.
Got it. Okay.
Right. Another example would be legal services. If your lawyers come in and help you with litigation or whatever, they're not going to bill you until like months ahead because they're lazy about billing. A lot of them are. I don't know if there are lawyers in here, but you guys are very lazy about billing. No offense. But okay, let's move on. Oh, okay. Does that make sense to everybody? Any questions on that? Because it's a rather difficult thing to understand. Okay. All right, well, good. All right, let's move on to the next question. How much PP&E did they purchase in 2019? First of all, what section would that fall under?
Would that be purchases of property and equipment?
Yep. And how much is that?
That is negative $246.40.
Yes, very good. Does that mean that's all the equipment they purchased that year?
At least that's what they've documented.
That's what they paid for in cash, right? So they could have taken on some debt to pay for certain equipment that doesn't get reflected here. So, that's what, at least that's what they paid for in cash specifically. Okay. Yeah.
Can you talk a little Can you talk
Yeah.
a little bit about how how like the PPE could also be under operating expenses? Wasn't that one of the, I feel like in class you talked about how some companies could put some of these things under operating or investing, but choose to do it under investing.
If their business model is to buy and sell PP&E, like if they make the property, plant, equipment, so if they make machinery, I could see that under operating. Typically you wouldn't. I don't think you would. I don't know what context he was talking about. Do you have any more information on like the context he was under? Or?
No.
Okay,
It was
okay.
briefly mentioned in class that he could, you could put some of these in different places depending on kind of your accounting strategy.
Got it. Okay.
That's fine.
Is my mic staticky? Or it is? How bad? It's okay. Oh shit. Man, let me see if I can turn off this. No? Shit. You guys hear me? Good? No? Good? A little better on the static? Yeah, okay. I'll leave my headphones off then. All right, great. Let's move on. How much do they borrow? So first, what section would this fall under? Oops, sorry.
If you're borrowing money, that's a liability.
Yes, it is, but specifically on the cash flow statement, is it cash flow from operations, investing, or financing?
Financing?
Yep, it's financing. Okay. All right. So how much money do they borrow?
910.
Yep, very good. It's right here. Proceeds from debt obligations. They took on debt, right? And how much money do they pay off in debt?
1065.
Yep, there you go. Very good. And how much dividends did they pay?
498.6.
Yeah, very good. Yeah, that's pretty much how you identify stuff on the statement of cash flows. So it's good to go through that exercise initially. So you can, like, if you ask more analytical questions, you can kind of say like, okay, how do they fund the cash flow from, like, how do they fund the purchases of PP&E? And presumably it's cash flow from operations, unless there's something glaring. That's kind of what I would say. All right, make sense? Any questions on this tab?
Ran, I have a quick question, and it might be a silly question, but looking at the different years for cash flows, are we looking at this in each year like we start new? So we shouldn't be comparing year to year of like how it changes?
So each year is separate. However, it is helpful to look at like how each year differs. I wouldn't say changes because it's not like, how does it differ, right? You can look at net earnings and say, okay, they made more earnings this year, but what's the biggest difference here? Okay, nothing crazy here, right? It looks like normal operations. You go down here, like, I guess nothing crazy is happening here. They issue some stock, or it looks like they bought back some common stock in 2018, but they didn't in 2019. So like you can see what activities they did and didn't do this year, and if there are big glaring differences, we'll see in the next few tabs. There's some glaring differences that you can look at. All right. Any other questions on this?
I
have a question.
Yeah, Katie.
So if the net cash used in financing activities is negative, you can kind of assume that any investing activities are funded by operating activities, right?
It's an assumption that I'm making.
Okay.
I mean, presumably, like they could have just taken some of this debt and paid off. Well, but then they paid off a bunch of debt here too, right?
Mm-hmm.
So it's tough to tell exactly how they paid for the PP&E, but I mean, it's fun. Like they have positive operating cash flow, so they could use it. They probably use it to buy PP&E and fund the dividend probably as well.
Okay.
Okay. Cool. Any other questions? Now we'll move on to Inditex. Does anybody know Inditex? Anybody buy Zara? Yeah, that really rich guy. Very cool. All right, same kind of activity is cash flow from operations. What is it? And this is a European company, so it's IFRS. It looks a little different.
It's in 2019, 6,695.
You're close.
Okay.
Got this number right. So look a little further down.
Oh, so 6,900.
Yeah. So for some reason, IFRS, they do all these weird highlighting, and I think there was an example from class that was similar. So it's important to look at the exact titles and the labels. All right. Does that make sense? Good. We're good with that. Okay. Even though it's IFRS, even though it's IFRS, the accounting principles still apply. Okay. So this is still indirect method. All right. Cash flow from investing. Let's go down a little bit. This is a little more straightforward.
2377.
2277, and cash flow from financing.
4629.
Very good. All right. Okay, similar question. On the balance sheet, did these accounts go up or down? Receivables, a -10 on the cash flow from operations.
Receivables went up?
Yeah. Receivables went up. Does that make sense to everybody? You didn't collect.
Explain that.
Yeah, so if receivables go up, so the revenue numbers, right? It's all incorporated into this profit before taxes, right? So the revenue, all these expenses, but the revenue incorporates the revenue that you got in cash and also the revenue that you got on credit. Some customers haven't paid you for that revenue or for like delivering the goods, right? You bought a dress on credit. This here is saying that their accounts receivables went up by 10. So of that revenue, 10 wasn't collected in cash. There was an increase of $10 million or 10 million euros of receivables. So they didn't collect that much money. And so you have to subtract it out of the net income to figure out exactly what happened with the cash activity. Does that make sense, Tommy? Yeah.
Yeah, thank you. That
Right.
helps.
Very good. All right, inventories. Same question. There is a cash inflow of 201. What does that mean for inventories?
They decreased.
Say again.
It went down.
It went down. Yeah. Okay. For inventories, I would just apply that general rule that I talked about. Inventories, if current assets go up, it's a cash outflow. Current assets go down, it's a cash inflow. All right. Payables. There is a change of cash inflow of 14.
So they increased?
Yeah, very good. Yep. Increased payables of 14. They didn't pay somebody for a certain expense. So the general rule for current liabilities is that if it goes up, it's a cash inflow. If it goes down, it's a cash outflow. Okay. All right. What was the biggest change under investing activities?
They paid a rent price for a lease.
That is financing activities. Remember, it's a little bit weird here.
Looks like they maybe paid back a loan, the current financial investments.
So so here's the cash flow from investing activities. So everything above it is cash flow from investing activities.
Yeah.
Is financing, everything above it is financing. So under investing activities, go ahead.
Is it the PP&E?
Yep, 910 million euros in purchases of PP&E. Does that make sense to everybody?
What about the one just above the green bar?
This one here.
Yeah.
Oh, this is oh yeah, actually changes in current financial investments. Oh, I didn't even see that. Okay, very good. Yeah, 2 of them. Thanks.
What would that be, the changes in current financial investments?
So what does that mean?
Yeah.
Yeah, okay. So investing activities typically mean for companies they invest in PP&E, but also if they buy financial assets in other companies. So they go out in the open market and they buy stock on the exchanges or mutual funds or whatever. Typically things that, like, if you have a lot of cash sitting on your balance sheet, you don't want it just to sit there. You want it to get some kind of return. So companies will do this and they call it investing activities. So sounds like Inditex had a lot of cash and they just bought a bunch of investments. Does that make sense? However, if you issue stock of your own company, that is not investing, that is financing. But does that difference make sense? Yeah, good. Okay.
Sorry, can you, that last point you just made, if you're like reinvesting in your own company, it's financing. That's what you just said?
If you issue stock in your own company. So if Inditex went out and did more, shares on the open market for their own shares, that is financing because you're financing your own company. That's not an investing activity.
Okay, cool. Thanks.
Cool. Okay, in terms of financing then, how much do they pay in leases? I think Rachel already talked about this.
1,836.
Yeah. Leases are a bit more complex. You're going to cover it in the next accounting class. There are different rules for leases. If you lease a building for like 90% of its life, then you're not really leasing it, you're kind of owning it. So that's why they put it under financing activities. You kind of, the rules are a bit different, but the numbers are here and I want to identify the biggest ones. Okay, and how much debt did they pay off in 2019?
$49.
Yep. And what else?
The
3.
Yeah, right. So there's 2. They paid off some non-current financial debt and changes in current financial debt. So about 52. How much do they pay in dividends?
27.
Yep. Yep. And if I were to ask you, how do they fund all those investing activities and financing activities, what would you say?
Operations.
Yep. Very good. Yeah, this one's a little straightforward, right? Like it's more straightforward because you make all this money from operations and pretty much spent a lot of it in all these other activities. So it's more straightforward to see. All right. Does that make sense? Any questions on that?
Would your dividends ever be positive on a cash flow statement?
They should never be positive.
Right. Okay. Thanks.
If it's positive, then you're like taking dividends from other people. Yeah. There's no situation where
You're admitting a crime, basically.
Right. Yeah. Cool.
Rand, can I ask a question real quick?
Yeah, sure.
The debt being negative, that tells us that we're paying off debt, right?
Exactly.
If the debt is positive, does it mean that we took on more debt?
Yes.
Okay.
That's exactly what that means. Yeah.
Great. Thank you.
Cool. Any other questions? Great. Moving on to Hilton. This is a good exercise. This is 6 months ended in 2020 for June 30th, 2020. So it incorporates all the coronavirus activities. Okay. What was Hilton's net income for the 6 months ended in 2020?
Negative 414.
Very good. And what was their cash flow from operations?
$946 million.
Yeah, very good. Okay, so the question is, how did they get from negative 414 million to almost $1 billion of cash flow from operations? This is more analytical, so it's a little different from the previous two.
Looking at row 13, is it because they got paid back from some of their customers?
You're on the right track, but I mean, I wouldn't expect you to know this, but the change in liabilities with contract from customers, that's an event. Good job. It's an event that didn't happen last year, that happened this year. It's $725 million, the biggest change here. And you kind of have to go to the footnotes for this. They contracted with Amex to get prepaid for rooms and services with Hilton. So they got the money. What does that sound like to you in terms of what would go on to the balance sheet? They got paid by Amex.
But it wasn't cash. Is that the point?
No,
Like
it is cash, right? Because it's an increase of $725 million in cash.
So
it's unearned revenue.
Yeah, it's unearned revenue. Amex paid them. Like, I would assume that Hilton gave them like really discounted rates. So Amex took advantage, paid them the cash, and now Hilton on their balance sheet has the liabilities of unearned revenues. Okay, does that make sense?
would that have originally been 725 in accounts receivable for Hilton?
No, so that would originally not been around. That's a unique deal that they did. Does that make sense?
Sorry, I missed what you said. Sorry, could you say
yeah, so that's a unique deal that they did. That's a one-time kind of deal because it didn't happen last year, happened this year. They did,
oh, I see. Right. So they wouldn't have even had an entry for last year.
Yeah.
Got it.
Yeah.
Okay. Got it. Okay, cool.
Cool.
I have a question about that. Is it unearned revenue because it's like a prepaid expense for Amex? Like they're paying for rooms, but because they haven't used the rooms yet, is that why it's unearned?
Yeah. Amex paid them. I mean, at some point, Amex, I would assume, will use the rooms and then it'll be earned revenue. But right now, they have not delivered the rooms because nobody's staying in hotels. Cool.
What would it be if it were the other way around, that they used the rooms and now they're paying it back? Is that accounts?
So if they use the rooms and they didn't pay for it, they'll pay for it later. What does that sound like to you?
So is that accounts receivable?
Yeah.
Okay.
Hilton's delivered the goods, they've earned the revenue, but they just haven't paid for it. Cool. All right.
Thank you.
Yep. How much did Hilton have in cash on 6/30/2020? All right. So you have to kind of go all the way down here. How would you identify that?
Is it the 3,575 at the end of the period?
Mm-hmm. It's right here, right? Yep. And the question is, they had, so companies, when they build their financials, they look at the 6 months ended in June 30th, 2020 versus June 30th, 2019, because you're kind of comparing the similar time frame to adjust for seasonality, and you're comparing apples to apples. So this year they ended with $3.6 billion. Last year they ended with $700 million. What's the difference here? How do they get to this number? Oh, also, what is the beginning balance cash flow? Or what is the beginning balance cash account that they had on hand? So say at 1/1.
The 630?
Yeah. Yeah. Good job.
And they borrowed 2,690 million.
Yeah, that's a huge number, right? So this is kind of the analytical portion of the cash flows. How did they get from 600 million to $3.6 billion? Well, they borrowed almost $2.7 billion. Presumably they need cash, so they borrowed money. Hilton's struggling, and a lot of hotels are struggling. So if you guys are courageous enough, go stay in a Hilton or something. I don't know. Cool. Any questions on that?
Could you explain row 28? So it looks like a year ago at this time, it was negative.
You're asking about this negative 323 number. So it looks like they paid off more debt. They also repurchased some of their common stock. So that's like Hilton going out in the open market and buying back their own stock. So that's called treasury stock. So they did a lot of that. And they'll do that because they feel confident in their own stock price, or they'll do that to fund their employee stock options. Some companies will do that on the open market. So at the end of the year, or at the end of the 6-month period, the net cash used in financing activities was a negative number. So they spent cash financing the company. Okay, makes sense so far. Any other questions? No questions. Perfect. Okay, yeah, how did they get more? Yeah, they borrowed. Great. We're going to go on to property, plant, and equipment. If there's no questions on, or any questions generally on cash flow statements. Cash flow.
Can I ask one quick question,
Yeah.
Rand?
Yeah.
You said it a couple of times. I just want to make sure I wrote it down right. So when we're looking at assets and assets increasing, it's a cash outflow. And when assets decrease, it's a cash inflow.
Yes. Yeah.
And then
more specifically, it's current assets.
Current assets. Yep. Okay. I wrote down current assets. And then same thing for liability, but when but it's like it's flipped. Like when the liability increases, it's a cash inflow.
Mm-hmm.
And when it decreases, it's an outflow.
Exactly.
Okay, cool.
Yeah.
Thank you.
And current liabilities as well. Yeah, so why we do current is because that is the normal operations of the business. Like accounts receivable, it's a normal operation. Inventory, accounts payable, accrued expenses, they're all normal operations, everyday stuff. Debt is not a normal operation. That is one time, similar to in buying PP&E, they're one time expenses or capital expenditures. Cool. Any other questions on that? Cash flows? Cool. Well, ace the cash flow section. Let's move on to PP&E and depreciation. So I've created this problem, easy numbers. So you bought equipment for 100,000 with a 10-year life and $5,000 in salvage value, and you pay for it all in cash. So I want to go through the journal entries. All right. So on when you bought the equipment, what would be your journal entry on that day? Volunteers.
Would that be debit, PP&E, credit, cash? Assuming it was paid in cash. Yeah.
Good. Easy enough. Okay. Oops. All right. Perfect. Great. Any volunteers for the journal entry on December 31st, 2020? What has to go there? What do you have to do?
Debit depreciation expense and credit accumulated depreciation.
Okay. For how much? I can do the math here if you want me to. Just tell me how.
Thanks. Yeah. It would be the 100,000, but taking out the 5,000 of value and then divided by 10 is our annual depreciation, right?
Yep, you're right. Very good.
Okay, so yeah, 9,500.
Very good. All right. Okay, so now this next question I want to ask is, say you decide you don't want the equipment anymore and you sell it for $45,000 in cash at the end of 2025. Okay. It's a little more involved, but you can get through it. Any volunteers? I can cold call them, but I don't want to do that.
So you would debit cash.
Very good.
45,000.
Yep.
Credit
Uh-huh.
PP&E for 4,500. No, it wouldn't be 4,500. It
Ooh,
has to be higher.
you're right with this. So it's a common mistake with common mistake with selling PP&E is that the PP&E and the accumulated depreciation are separate accounts. Remember that. Keep that in mind. So how much would you credit PP&E?
$100,000.
Yeah, 100,000, right? Because they're separate accounts. So the PP&E here stays 100,000. That doesn't change. The only thing that changes is the accumulated depreciation year over year, and that goes to decrease PP&E. It's a contra asset account, remember? And the net PP&E is the line that shows up on the balance sheet. Okay, so when you sell or get rid of your PP&E, you have to kind of reverse out both of these accounts. All right, so let's continue. We're on the right path. What's the next entry here?
Do you debit the depreciation expense for the 57,000?
You're right in the 57,000, but it's not depreciation expense.
Did it accumulated depreciation?
Accumulated depreciation. Okay, this is why I have this schedule here. Every year, this is depreciation expense. Depreciation expense every year is 9,500. All right, that is a temporary account. It gets zeroed out after the year is over and starts new every year. That's why it goes up. It goes to 0 and then up to 9.5. 0 up to 9.5. The thing that accumulates is accumulated depreciation because it's in the name. It accumulates. All right. So now this is balanced.
Sorry, Rand, quick question.
Yeah.
Isn't accumulated depreciation always a credit account? So it should be a credit
Oh,
as
you mean
opposed to
here?
a debit?
Yeah. So when you said, yeah, right. Good question, Lee. When you do the journal entries, it accumulates here, right, as a credit. But what are we doing here? Why are we debiting it?
Because we're closing the account?
Exactly. We're closing out that equipment. We have to reverse out the accumulated depreciation. Yeah.
Brandon, can I ask a question?
Sure.
Are any of these adjusting entries, or did we do it correctly so we don't need to adjust things?
So let me think. Adjust, like this might be called an adjusting entry. I think this is an adjusting entry at the end of the year. In my previous job, we did adjusting entries for prepaid insurance on a quarterly basis. So we would prepay for an entire year, and then every quarter we would reflect the quarter, like divide by 4 that expense. So it was an asset, we put it into an expense account. That's an adjusting entry that we did. So yeah, like you reflect what happened over the year. So yeah, I think the depreciation will be a adjusting entry. Prepays are pretty popular, things like that. Okay.
Hey, Ren. Just kind of going off of that question, where I always struggle is like figuring out the difference between a regular entry, an adjusting entry, and then closing entry. Could we kind of go through that with depreciation?
So depreciation is the adjusting entry here. Like at the end of the year, this is an adjusting entry, right? You're adjusting the PP&E, you're adjusting the accumulated depreciation at the end of the year. Typically, you're going to have software that just tracks this and it makes the entries like automatically. Another, like I said, another adjusting entry would be, the prepaid expense. You prepay the expense. Let's say it's prepaid rent, and at the end, like you prepay the rent at the beginning of the month every year, right? And at the end of the month, you have to adjust it to reverse out that prepaid and put it into expense. So you pay rent at the first of the month for that month, right? So you prepay that, whatever, $1,000, and you're allowed to stay in your room for the month. And at the end of the month, that becomes an expense, right? Because it's no longer a prepaid. The landlord has earned it. He or she has delivered the room to you, and now you have to reverse out the prepaid as you credit the asset, and then you debit the expense. So put that under the income statement. Does that make sense?
Yes.
Insurance is a popular way to do it. So those are adjusting entries. As far as closing entries, it's typically to like retained earnings and closing out all the accounts of like revenue at the end of the year, right? Revenue has to go to zero after you created the income statement. Revenue has to go to zero. So the closing entry is just like reversing it out, and you typically don't see it. You just see the retained earnings getting zeroed out.
When do you report the gain or loss?
What do you mean? Can you be more specific, Daddy?
Sorry. So for this one, I didn't do the math, but yeah, correct.
Yeah, so we haven't finished this question yet. We kind of got sidetracked with other questions, but I'll come back to it if the closing entries and adjusting entries make sense. So that
I have another, oh, sorry.
No, go ahead, Lee.
Just, I was under the impression that accumulated depreciation was a permanent account. So I didn't think permanent accounts really got closed. So
you don't close this account. You mean this here?
Yeah.
This account is not being closed. We're closing out this equipment specifically. So this is not the only accumulated depreciation in this company, right? Like they probably have other equipment that is in there. We're just taking this out of this account, this number out of this account. This account probably has like millions of dollars in it. Does that make sense?
Because it's being sold, so we're taking, like, it's no longer something we own, so we're no longer accounting for the accumulated depreciation for this piece of it. Okay, got it. Thank you.
We're scrapping it.
Along those lines, anytime we have PP&E, we also have to include accumulated depreciation, right? Would there be any scenario where you wouldn't have accumulated depreciation where you're talking about PP&E?
No, all equipment gets depreciated. The only thing that amortization is related to intangible assets.
Okay.
But the only thing that doesn't get amortized is goodwill, which you probably have not talked. I don't know. Have you guys talked about goodwill? Will that be tested?
He has mentioned its existence.
Yeah.
I don't think it'll be tested then. But goodwill is like if you buy another company. If one company buys another company, they have to incorporate all the assets and liabilities into their balance sheet, right? But those are historical numbers. And so those are historical numbers. So you typically pay a lot more than what it is on the balance sheet, what the historical numbers are. So the goodwill is to account for that difference. Does that make sense?
Yeah, and then
book value.
And PP&E is always tangible, right?
Yeah. Like equipment or buildings or land. Oh yeah. Sorry, land does not get depreciated. I forgot to mention that. Land does not get depreciated because it's land and it's always there, hopefully. Okay, let's finish this question real quick. All right. Does this balance? I think Dottie was on the right track here. What are your debits and what are your credits right now?
The debits sum up to 102,000 and the credits only sum up to 100,000.
Exactly. So this journal entry does not balance. We need to figure out if it's a loss or a gain, and we need to make that entry. How would you figure out if this is a loss or a gain?
I figured it out by subtracting the 100,000 from what we had on the debit side, so you end up with a gain.
Yep, you would end up with a gain, And you're right, you just subtract these two from this, right? An easier way, a more intuitive way to do it is say, okay, you had historical cost of PP&E, you've depreciated it for now 6 years. What is your net book value? $43,000. And how much did you get paid for it in cash? You got
45, so you made money.
45,000. Exactly, you made $2,000 a gain. And gains are what? Credit or debit?
Credit.
Yeah, it's a credit. Gains follow the revenue idea. Gain of 2,000. Very good. And that is our journal entry. And so if you didn't sell it, you would depreciate it for 10 years. So for 10 years, you would get, so this times 10, you get 9,000 or 95,000. And you had PP&E of 100,000. You subtract these two, you end up with that salvage value of 5,000. And presumably you might be able to sell it for 5,000, but 10 years later, I don't like, it's an estimate. Typically, it's not very accurate. More or less an accounting.
Can you clarify why a gain is a credit?
A gain, so revenues are credited, right? That increases your income. Gain is a similar way. It's credited to increase your income. Does that make sense? It follows that convention on the income statement.
Yeah. Okay.
Cool.
I had another question, if that's all right. Can you, I know we were talking about contra assets and Alex put in the chat something about it too. Can you just go, like, just I don't know if this would be helpful for other people, but just like the logic of them, like why are certain things contra assets? Like what is kind of the point?
Yeah, so with accounting, you want to account for everything, right? Like you, yeah, so contra assets, like you can just take the PP&E and just decrease PP&E over year, but then after, like, I don't know, if you have hundreds of thousands of dollars or millions of dollars of PP&E and they're all accounted for, but like you just go to decrease, you forget what you actually paid for. You forget that it was actually $100,000 at the end of the year, or like at the end of the day, like you forget, like there's a lot to account for. That's why you keep it separate. It makes it easier. Another contra asset account is bad debt expense. So related to accounts receivable. So you sell stuff on credit, and your customers presumably will pay you back, but not all of them will. Some of them will go out of business and can't pay you back. So you have to estimate exactly how much of that accounts receivable you expect to collect. And based on historical data, it's typically like less than 5% of accounts receivable you expect to be bad debts. So you have gross accounts receivable, you incorporate bad debts into it, and then you get a net accounts receivable, which is what shows up on your balance sheet. That's what you realistically expect to collect from your customers. So you have to keep those separate, because if you say like, okay, we, next year, less than 5% went back, actually all of your customers paid, then you have to reverse out that bad debt expense, but the accounts receivable still remain, right? So there's a lot of, I don't know, intricacies when you get into accounting. You have to keep these separate to keep it clean. Does that make sense? It's a lot more of a type A kind of deal than like, I don't know, like common sense. Does that make sense?
I guess it makes sense in theory.
Like it keeps track of all this stuff because, like, especially for depreciation, GAAP has specific rules. How long you can depreciate something. And so when you start mixing it, just like depreciating without a separate account, it gets really messy.
Okay.
Okay, I mean, yeah, that's just the way accountants do it. And over years and years of accounting theory, they decided that that's the best way.
Okay. So like if a question was like the example you're just giving of like you sell something on credit and you expect, and at the end of the year, only like 90% of your customers have paid or whatever, So that remaining 10% would be a contra asset of what you're.
Yeah, presumably the 10% is a contra asset. I don't think you guys have gone over bad debts, so I don't think you need to worry.
But I'm pretty sure it was.
Oh, it was.
There were questions on contra assets on the last quiz, I think,
Okay.
quizzes ago. So
It just know that it goes to decrease a certain asset. It's related to a certain account, right? And
yeah, so it just works in reverse of an asset then with the debit and credit. Okay. All right.
He went over bad debts.
To be honest, I'm not sure, but I do know that we talked about contra assets.
Okay. Yeah. I mean that's the purpose of contra assets, just to keep things different. Cool.
Thanks.
Any other questions?
I just had one last question about that.
Sure.
So is depreciation at any point a contra asset?
Accumulated depreciation is.
That is, okay.
Depreciation expense is on the, thanks Jackie, on the income statement. Right, so that gets zeroed out as a closing entry at the end of the year.
Okay.
So for accumulated depreciation, it would be acting in the same way as an asset, right? Not the opposite of an asset, like we just said. Because like where it's debited with cash on this example.
This is a sale though. On a regular, so like if you were to just have equipment and depreciate it, if you didn't sell this equipment and you just depreciated it, so let's just say it's 2 years, your accumulated depreciation would be 19, and that is
Okay, so the debited accumulated depreciation isn't the contra asset, it's the credited accumulated depreciation above it.
Yes.
Okay.
Yeah. So this is where we're selling it.
Mm-hmm.
We're selling that whatever machinery that we bought. So we have to reverse out that accumulated depreciation to get it out of our books because we're getting rid of every account related with it. We have to get rid of. Make sense?
Mm-hmm.
Okay, good. Any other questions before we move on? Okay, good. I'll go over the overstated, understated, and then we have a couple of examples of cash or prepaid, and we'll go over questions you might have specifically to you. So try to go through this quicker than normal. Okay, you guys get this overstated, understated question, right? Quite a bit. Okay, or I mean, like you gotten it from the professor. Yeah. Okay. Your company. So for number one, your company in 2020 had expenses of 1,000, but you messed up, and it should have been 2,000. All right. So what items are overstated or understated in the following? So on the income statement, what items would be overstated or understated? What, I guess, accounts are affected here? And let's just bucket it like income, revenue versus expenses, nothing crazy.
So revenue's overstated?
No, revenue is not affected.
Your net income is overstated.
Yes, so let me do an example, right? So this is wrong and this is right. So in the wrong section, so revenue, let's just say it's $20,000. Nothing changed about revenue, right? In this example, revenue stays the same. Nothing in the fact pattern indicates that revenue changed. What was wrong is your expenses, or are your expenses. What was it before? It was $1,000. Actually, let's just make this 5,000 instead. And what should it have been? 2,000, right? So your net income you said it was 4,000. It should have been 3,000. So you're communicating to your investors. Okay, I have $4,000 in net income. Oh, I was wrong. It should have been 3,000. So Lee was right. Your net income is overstated, or was overstated. What else was overstated or understated? What changed here? What else changed?
Your expense would be understated, right?
Your expenses were understated. Does that make sense? Questions on that? Okay, now let's move on to the balance sheet. This is the income statement. we should move on to the balance sheet. What on the income, or what on the balance sheet is overstated or understated? What accounts are affected?
I guess it would depend on where the expense was coming from. So if it was like an accounts payable that you haven't marked as paid, that liability has been overstated.
Yeah, so you're on the right path. Yes, liability. Let's just say it's just, I don't know, some expense that you forgot to account for. Like you just wrote it wrong, right? So what do you have to do? What do you have to do?
Increase liability?
Yes, you just have to increase the liability. So let's just say it's accrued expense, all right? And just say you didn't, let's just say you didn't, you had $1,000, right? It was wrong. It should have been what, 2,000, right? So your accrued liabilities or your accrued expenses / your liabilities in general is what? Overstated or understated?
Understated.
Yes, understated. Should have been 2,000. You told them it was 1,000. That makes sense? Yeah. What else is affected?
Your assets would be overstated, right?
Why?
Because you didn't take out the expenses.
Oh, the expenses do not affect assets, remember? Or actually, cost of goods sold would affect inventory. But in this example, we reflected the change in expenses in the liability section, right?
Doesn't the asset side have to equal the liability side though? So if it's understated liabilities, then it would have to be overstated assets.
What else is on the liability side in that equation?
It'd be overstated equity then.
Yeah, exactly. Very good. Equity. Why is equity overstated? So, yeah, why is equity overstated?
You're paid in capital, isn't what you thought it was?
It's not paid in capital, it's something else.
Retained earnings.
Retained earnings. Yeah. So equity / retained earnings. You say it increased by 4,000, but it should have only increased by 3,000. So your equity is overstated. That makes sense? Good. Questions on that one? So we ignore taxes in here, and presumably he will as well in the exam. Okay, move on to this next one. Same thing. We'll just do wrong and right. We'll assume revenue of 100,000. Perfect. All right. So your company had 15,000 in depreciation expense, but you were wrong. It should have been 20,000. Same question. What's overstated, understated? What accounts are affected? Let's go with income statement first.
So expenses understated.
Very good. Oh, Trevini is in the waiting room. How do I get her in? Not the waiting room. Alex, can you tell her to rejoin maybe?
Yeah.
Thank you. I don't see her. No, I don't see her as in as waiting. Let's finish it. Oh, there she is. Great. Awesome. Okay. Katie, you said expenses, right? Was it Katie? Or is it somebody else? I'm sorry. Oh, it's Michaela. I'm sorry. You guys are next to each other. Specifically, what expense was
Depreciation.
depreciation?
Mhm.
If you said it was 15,000, it should have been 20,000.
Mhm.
So it was understated.
Mhm.
Very good. And okay, so let's assume nothing else happened. Your net income is this. Very good. Okay, so what about your net income?
It's overstated.
Overstated. Very good. Now let's move on to the balance sheet. Okay. What does this affect?
Your assets.
Assets. Which assets? Specifically, we're dealing with depreciation expense.
PPE.
PPE, very good. PPE, specifically the contra asset, right? Accumulated
Oh, yeah.
depreciation. Use, let's just say it's the first year, right? You said it's 15,000, should have been 20, and that's an extra 0. 20,000, should have been 20,000. So your accumulated depreciation is what? Understated. Okay, very good. And therefore your PPE, presumably, what would your PPE be? Would it be understated or overstated?
Overstated.
Overstated. Very good, because you said, you should have had more depreciation, so the net number should be lower. What else? What's the balancing act here?
The equity.
Yeah, equity, more specifically. This equity slash
Retained earnings.
Yep, very good. You said it was 85, or it went up by 85. It should have only gone up by 80,000. So your equity is what?
Overstated.
Overstated. Yep. Do you see how it balances? Your PPE was overstated by the 5,000, and your equity was overstated by the 5,000. So it balances. Cool.
Rand, can I ask you a quick question?
Yeah.
I was looking at some of these last night. When the net income is overstated or understated, we then can conclude that equity is also going to be overstated or understated, or is that not correct?
No, that's correct. It should change equity because it changes retained earnings, right? The financial statements will flow through each other.
So then if your net income is not impacted, we don't need to jump to equity and think like, is it overstated or understated? It should probably be like no change or no impact as well, right?
Yeah, unless it affects some other account in equity, like common stock or paid in capital or something like that. But yeah.
Thank you.
That's a good rule. Cool. Any other questions on overstated, understated? Very good. Okay, great. Cash paid for. This is one of those. So cash flow statement of cash flows is typically indirect. This is what the direct method kind of looks like. This is what you would do for the direct method. And I think there's a few questions about this stuff. So it's good to go through this quickly. Let's just say prepaid insurance expense, right? That's a prepaid, what is that? Asset, liability, or front-load equity? Prepaid expenses.
Asset.
It's an asset. Very good. You paid for something, and you're gonna get benefit from it later. So your prepaid insurance expense account, beginning balance was 10,000. The ending balance was 15,000. And during the year, you had insurance expense of 20,000. All right. What was cash paid for insurance in this year? Who wants to give it a shot?
Rand, can you repeat that again? Sorry, I didn't quite follow you.
Sure. So you have a prepaid insurance expense account, right? You started with 10,000, that's your beginning balance, and you ended with 15,000, right? But during the year, your insurance expense was $20,000. What was the cash paid for insurance?
35.
35? How did you get 35?
Okay, expense is 20 and ending balance is 15. So the total amount that is paid, so prepaid expense, 25. The difference of 5 plus 20.
Yeah, very good. 25,000. Okay, does everybody understand how we got there? No. Some people do, but some people don't. Okay.
Can I try to talk it through?
Yeah, yes, you can. Please.
So you began with a balance that you expensed at some point during the year.
Yep.
So half of that 20 is the 10 that you already had.
Yep.
So you still have another 10 that you expensed at some point during the year.
Yep.
Plus the 15 that you put into prepaid.
Very good. Yep.
Okay. Okay, thank you.
25,000. So that's one way of looking at it, right? An analogy. So does that make sense to everybody, what Kate just said? Is it making more sense? So another analogy that you can use is like if you have a gift card, you got the gift card with 10,000. Let's just say nothing else happened, the 20 didn't exist. You get a gift card for 10,000, and then like I don't know, at the end of the year, you had a gift card. The same gift card had $15,000 in it, and nothing else happened, right? What presumably did you do during the year? What'd you do with that gift card? You spend money, you put money in.
Put 5,000 more on it.
Yeah, you put $5,000 more into this gift card for insurance expense, right? So your cash paid is $5,000. Okay. Now let's just add an extra layer of complexity. Let's just put 20,000 back in. So you get the gift card, 10,000. You spent 20,000, right? But you still ended with 15,000. So how much money had you have to have paid to get to this ending balance?
Oh yeah, 25.
Yeah,
Then-
right. So
yeah.
like let's just say you spent 20,000 and then you ended up with 15. So you had to put $25,000. You had to pay for this, and you had to put extra money in to get the balance up. But what Katie said also makes a lot of sense, right? You had this balance. At some point you expensed it. You use that balance up to get it to zero, but you still had $10,000 of expenses, right? So you had to pay for that. But at the end of the year, you had an extra 15. So the 10,000 you paid for with cash, and then you paid for another 15,000 to get that balance back up, presumably for next year when your insurance expense or like the insurance company increase your insurance expense. Does that make sense?
Can you always just add the beginning and end balance?
You cannot, because something happened, right? So the formula here is you take the ending balance, you subtract the beginning balance, and you add any expenses, and you get the 25,000.
Wait, could you, okay, so it's 10,000 minus
So it's
20,000?
let me do that again, right? So it's the ending balance, the EB.
Okay.
Subtract the beginning balance, and you add whatever expenses you had to pay for. It's 25,000. All right, let's go with another example. Help make it clear. All right, so prepaid rent expense. Similar idea. You started the year with $100,000 in prepaid rent. This is like Chipotle or something. They prepaid their rent, and you guys prepay rent too, right? Like you pay on the first of the month for to stay in the month. You started with 100,000. You ended with 80,000, right? So, okay. Tommy, are you sad? Sorry. Let's just say, let's forget the 500,000 real quick. Yeah, prepaid rent sucks. Let's just forget the 500,000, right? If you started with 100,000 in prepaid, you ended with 80,000. What presumably happened?
You spent 20,000.
Did you spend 20,000 in cash or something else?
You used 20,000 in rent?
Yeah. You of this 100,000, you used 20,000, right?
So maybe it was like 2 months at 10,000 each or something if you're
Yeah.
like a okay.
Exactly, right? Like maybe we make it a little easier. Let's just say it's 12 for the year. You prepaid for the year. You use 20, 2 months, and you're left with 100. Right? Does that make sense? That's assuming nothing else happened. Now let's just say 500. I don't know, your landlord's a dick and he increased your rent. I don't know, something happened. Okay. How much cash did you pay? How much cash did you have to have paid?
520,000.
You're close.
Be 480, right?
180. Alex, do you understand that? You see that? So let's just
Oh,
say
yes, because it's prepaid. Yeah, yeah. Okay.
Yeah, right. Like you're like, oh, we're gonna prepay the whole year, but then your landlord comes in and says, no, it's actually 500,000. So what you can do is say, okay, for Kate Bodner's example is that, okay, we use all this 120,000, right? What's remaining that we still have to pay for? We still have to pay for this 380. So if we only pay 380, this would be zero, right? Because this equals to 500,000. But no, we didn't do that. We're overachievers. We ended up with 100,000. So you still have to pay for the 380. But you're like, no, screw you. I'm going to put more money in. So you have to have paid 480 to get to that ending balance of 100,000. Okay. Does that make sense? Everybody? Good. Good. Questions?
Could you highlight over?
No, go ahead. Yeah. Sorry, Daddy, did you?
Sorry, I'm having technical issues. Could you highlight over the 480 so I could see the
One here.
formula that you used?
Yep. Oh, you know what? Let me do the formula separately here. Let me do this similar formula. So same formula gets you the same answer, or the correct answer, right? Ending balance, subtract beginning balance, plus any expenses gets you to the 480,000.
Can you repeat that, Rand? Ending balance?
So if you do ending balance, subtract beginning balance, add any expenses related to this account, and you get the 480, the correct answer.
And that gives you your cash paid during that
That's
time.
your cash paid, yes. Okay, let me see. Yeah, yeah, Kate's formula is, yeah, just rearrange what I did. Yeah, I do it this arrangement, or I do it this way because it makes a little more sense to me intuitively, but whatever formula you guys want to use, as long as it's that rearranged. Whatever property that is that you learn in geometry, I can't remember. Okay, so I had a question about accrual versus deferrals. I'll just go over it real quick. Deferrals are like, what's an example of a deferral?
Prepaid rent.
Yes, very good. What's another example?
Prepaid insurance.
Yep. Give me something other than a prepaid expense.
Unearned revenue.
Unearned revenue, very good. Yeah, that's typically, some companies will call it deferred revenue. You get paid cash for some benefit deferred to the future. Okay, an accrual. So does that make sense, the deferred? Yep, good. Questions on that one? No, good. Accrual is the opposite of that. You benefited with some service or thing, and you are going to pay for it later. So an accrued expense is like you pay a lawyer. No, that's a prepaid. Sorry, accrued expense.
Like someone working.
Yeah, is it a wage?
And you pay them later.
Yes. Okay. So actually, a lawyer is a good example. So you hire a law firm. They do a bunch of work for you, but they don't invoice you or they don't charge you yet. Lawyers take a long time to invoice people, right? Another accrual is audit expenses. Companies will, at the end of the year, they have to incorporate an audit expense into their financial statements because that's an expense for that year. But the auditors don't do work until March or February, and they'll invoice you then. So you don't pay for that yet, but you have to accrue the expense for the appropriate period. Does that make sense? So on the revenue side, right? So for the deferral, we had deferred revenue and prepaid expenses. For the accrual, we have accrued expenses, but on the revenue side, what is the corresponding accrual?
Is it kind of like revenue and accounts receivable?
Yeah, it's accounts receivable, right? You delivered something, you provided the service, but you haven't been paid yet. So some your customers will pay you at some point in the future. Make sense? Good.
So I think about it as deferral is when cash has exchanged or has been exchanged, and accrual is when cash has not been exchanged. Is that a fair way to think about it?
That is a great way to think about it. Yeah. Very cool. All right. Good. Any questions on that?
Can you
Yeah.
explain
Yep.
why? I know that accumulated depreciation is a deferral, but I've memorized that rather than understanding that.
Accumulated depreciation is a deferral.
I think we had a quiz question on that once.
Really? I don't know.
I can't logic it out.
Is it because you've already paid for the asset and now you're just depreciating? You're not like cash is you've already had a cash outflow when you've paid for the PP&E.
Yes. So.
I'm okay with that.
Deferred expense. Okay. Yeah, I guess that makes sense. I guess I never thought about it that way. I don't know. You guys seen this definition, right? Yeah. Okay. Does that make sense? I guess you were right. Yeah. I never thought about it that way, but yeah.
Yeah, if it weren't a quiz question, I wouldn't have thought about it at all.
Yeah. Cool. Other questions? Any specific questions on like quizzes and stuff? Like you have a quiz problem you want to go over? Remember, I can't give you the answer, but I'll try to point you the right direction. Nothing.
Not a quiz question, but if you could just talk about the cash conversion cycle. I found the wording on like the slides kind of confusing. So like, what is that?
Okay. What is the wording on the slides?
Let me pull it up. Give me a second.
Ryan, while she's pulling that up, I just like, do you have any suggestions as to the best way to study for this other than like going through the quizzes, coming to this?
Yeah, maybe, so like if you see a quiz question, like maybe creating your own questions. I think that's helpful, like creating your own numbers. Like if you have a quiz question, maybe change the fact pattern a little bit, maybe change the numbers and see if you can get to like work through the logic and get to the answer. That I used to do that a bit. Yeah.
Hey,
Cool.
Ryan, I have a question that I don't know if you want to address it after Alex brings hers up, but there are a bunch of questions on the last quiz that we had about current ratios. So I don't know if you can just go over those.
Current ratio is current assets divided by current liabilities. Sorry, I have not had coffee today, so. All right, it's current assets divided by current liabilities. Okay. Let me open this up. Sure.
Yeah, so I was looking at like page 32, how he kind of defines it as the number of days to convert inventories to cash versus number of days to pay for inventory. Wasn't really sure what that meant.
Sorry. 32.
I think it was 32. Yeah, that's what it says.
I only have 29 pages.
Did I upload the wrong one? That's very possible. I've been looking at a lot of these. Sorry about that. I think I uploaded session 3 instead of the more recent one. Here it is.
I'll come back to the current ratio. Okay, so to convert inventory to cash versus number of days to pay for inventory. Oh, interesting. So there's a turnover kind of deal.
Okay.
Okay. Let's see, what can we learn by considering the following items simultaneously? Average collection period for receivables, average holding time for inventory, and average payment time for suppliers. Okay, so so receivables, like your customers promise to pay you back. How long does it take? Basically, how long does it take for them to pay you back? Typically not very long, less than 30 days, hopefully.
Right.
Whatever credit terms you extend to them, hopefully they pay you back. If you're really bad at collecting receivables or your customers like just suck, it'll be longer, and that's a bad time because you deliver the goods, you can't turn that into actual cash.
Yeah.
Inventory, similar inventory holding period. So you create the inventory, right? And how long does it take for you to sell it and make it into cash? Cool, thanks, Carol. And those two items, you compare that to how long it takes for you to pay your suppliers.
Okay.
So when you look at those numbers, like, okay, how fast can you turn the inventory and receivable into cash versus how long do you have to pay for your suppliers? It's kind of looking at like how quickly you can turn over short-term assets to cash so you can cover your expenses. Does that make sense?
Yeah. Yeah.
So if say like your inventory holding period is 10 days, but you have to pay your suppliers within 5, then you're screwed, right? Like if your receivable holding period is like 10 days, and you have to pay your suppliers in 5, but you're screwed. You don't convert cash for 10 days, but you have to pay your suppliers in 5. That's not a good business model, right?
Okay.
You're going to run out of cash really quickly, and your suppliers are not going to be happy. So typically you negotiate better terms with your suppliers and shorter terms with your customers, and you try to turn over your inventory quicker.
Thank you.
Cool.
If we haven't seen any questions testing us on this kind of stuff on the practice quizzes, do you think that we'll be asked to have to analyze this on the final?
I can't say yes or no, because the quizzes, they're sampled from a bank of questions, right? Like, I don't know, maybe you just didn't get one. I don't know. But like understanding, like basic understanding of like how this works, like what the effects are, kind of. I don't think he'll ask you to calculate it though, right?
And
Sorry.
Yeah, go on, Katie.
Oh, sorry. I just have like a quick clarifying question on this, like just for real life examples. This concept is kind of why maybe some like smaller businesses prefer to do all cash transactions versus like letting people use credit cards. Is that maybe part of the reason that happens?
Yeah, they're also probably like, that's really small business, right?
Yeah.
Not everybody carries cash. So like Amazon probably won't. Like if Amazon has cash, like there's no way they can run a business.
Yeah, I was just curious if that's like a real life example of
but also
how
they
this
might be
might
evading
apply.
tax. Cash business typically evade tax, though. That's something else to think about. So back to your current ratio question, it's actually very similar to last quiz twice, and they're the same questions. Okay, well I guess yeah. Okay, maybe they're not so extensive in terms of the banks. I don't know.
So DuPont ratios, would they be asked to evaluate RAND? Like, would we be asked to calculate the net income versus the average equity, all of that in the ROE and ROA ratios? Would we be asked about it?
Oh, I don't know.
Okay.
I remember he said that we're going to be given the ratios, but we're probably going to have to identify like if one company has higher one than the other, what does that mean? But he'll give us